Now, the Bank of England has issued its strongest warning yet about an emerging AI-fueled market bubble. In its latest Financial Policy Committee report, the UK Central Bank said US stock valuations now resemble levels seen near the peak of the dot-com era, raising the risk of a sharp global market correction. The warning comes as the S&P 500 hits record highs, up 14% this year, with 30% of its value concentrated in just 5 AI-focused companies. Nvidia, Microsoft, Apple, Amazon and Meta have the highest market concentration in 50 years. Global tech giants continue to pour billions of dollars into AI infrastructure. Nvidia's market value now exceeds $4.5 trillion, while OpenAI is valued at $500 billion despite not turning a profit. OpenAI recently signed a multi-billion-dollar chip deal with AMD, while Nvidia is investing $100 billion back into OpenAI. Oracle is spending $40 billion on Nvidia chips for OpenAI's project Stargate. Analysts warn of circular financial ties and inflated valuations, comparing the current euphoria to the internet boom. The question now is whether this is an AI boom or a bubble waiting to burst. Market concentration, cross-investments and sky-high valuations have raised fears of irrational exuberance, a phrase once used during the dot-com era. Yet experts know that even if the market corrects, long-term demand for AI infrastructure will remain strong. Economists expect that by 2030, AI will be embedded across most industries, suggesting short-term volatility may not derail the technology's long-term potential. For more on this, we're now being joined by Mark Brolin, geoeconomic and geopolitical strategist, live from London. Welcome to the broadcast, and thank you so much for joining us. Let me just get right into this. Do you see the parallels between this AI boom as well as the 2000s tech bubble?
Oh, yes, I do see many key parallels, including hype surrounding groundbreaking technology. But I also see two differences. The 2000 crash centered around a new platform, the internet, and so we had one bubble and we had one bubble puncture. AI is different in the sense that we see continuous innovation in actually every industry. That's the implication of all this. So we see innovation in every field. And I think another big difference is that today's AI leaders, the one you mentioned before, all have sort of cash flow, they have clients, and they have revenue. The main culprits in 2000, like Enron, that was style over substance. There was no fundamental sound picture behind Enron, but that's not the case today. So fundamentals today are more sound, and what I expect is actually more continuous mini bubbles, and perhaps over time in different industries, because since as I was mentioning before, AI will have implications in every industry. So it might build up many mini bubbles when some businesses go out of business, but I don't see the big crash coming in the same sense as it did in 2001.
All right, so could these high valuations and concentrated investments trigger a market correction?
Oh, absolutely. When you have concentration of the kind you mentioned these top 5 players, for example, it makes indices very fragile. So that could lead to, I mean, if sentiments change, and they can change when we are charting new territory, as we are doing now, they could change even for the wrong reasons, like herd mentality, psychology, overreactions. So we are probably going to see market repricings also continuously. But then again, and also we have some companies will, even if they have strong fundamentals, they will overinvest. Some companies, possibly like some people have said about Apple, might underinvest in AI, and that will also mean individual companies will go into trouble, and that will also lead to market movements. But so yes, there is. We have to see market corrections. They will be ongoing for quite some time. Yes.
Right, I will just come to that as well. But just to expand on this further, could global macroeconomic factors, inflation, supply shocks, geopolitical tensions amplify these risks of an AI-driven market correction?
Oh, yes. I mean, we have, among the risks, we have the usual suspects like supply shocks, ship supply, that will affect in a major way. We have inflation, that's much talked about. And I mentioned psychology before. That will also that will also have massive implications going forward. So I think there is one underestimated or under-talked about factor, and there is, I think, reason to believe that AI is about to improve the decision-making process and actually detect malpractices and including corruption, and that might lead to that might actually mitigate the troubles as well. So we have risks, absolutely, but we also have opportunities linked to this that perhaps we should talk even more about.
Right, let's also talk about the usual suspects. Circular investments like Nvidia investing in OpenAI while selling chips to it have raised concerns. Could these arrangements distort capital allocation in the sector?
Oh, absolutely, yes. That's a great question, because I think circular deals like that is a key problem in many industries, certainly also outside the AI industry. And that has been the case for a long time. There's a small number of players propping each other up, and that risks mispricing and not enough scrutiny of fundamentals. And that creates systemic risks. And also that problem is made much worse if, which is often the case, these big players are too close to comfort with the regulators. Then it's sort of a corporativist structure, and those kind of structures are feeding the populist movements. So that's also something we have to take a closer look at. And hopefully AI will be able to be helpful in some ways also in that respect. But it's a major issue, absolutely.
All right. Mr. Brolin, thank you so much for joining us on Business Insights with your insights on this.
Pleasure.
For latest news, download the WION app and subscribe to our YouTube channel.